Welcome to TaxLinked's latest webinar. We have two of our favorite panelists once again here with us to talk about US tax issues. Today we'll we'll kind of be introducing the network to the foreign tax credit system in the United States. I had a chat with John and Karen just now, and it's a very complicated issue, so we'll try to navigate our way through this. Some admin issues before we get started. You are eligible to receive CPD credits for this webinar, so make sure you're paying attention. The system tracks whether you're paying attention, so if you want that CPD credit, make sure that you're attentive. Also, if you have any questions as you hear John and Karen discuss the foreign tax credit system in the US, make sure to use the GoToWebinar control panel to submit your questions, and I'll make sure to pass those on to John, who will be moderating this event, or it'll be more a debate discussion between the two of them. I'm going to make myself scarce this time around. So I will pass the questions to John, and he will incorporate them into the discussion. Also, Karen has shared a handout with everyone. So make sure you go to the control panel and you download that handout. The handout will be useful when, in order to follow the discussion at certain points. So make sure you download that handout. I will also upload that handout on TaxLinked for future reference. So without further ado, I'm passing on the reins to John, who will lead us in this discussion. And I'll be back in about an hour to say goodbye to everyone. Thanks, bye.
Okay, well, thank you very much, Mateo. Although Karen and I have done these before, I think it might be good to begin with some introductions. Karen, do you want to introduce yourself and perhaps include some of your tax background and, all those great things?
All those great things. So I'm Karen Alpert, and I am a finance lecturer at the University of Queensland in sunny Brisbane, Australia. I come at this these tax issues from a different perspective. At one point in a prior life, I was a CPA in California in tax practice. Then I saw the light, had some kids, decided to move into academia. So I am no longer a qualified tax preparer, but I have a master's degree in tax and have previously prepared corporate tax returns and high net worth individual tax returns. So I come at this from a more academic point of view. What does the law say? How does it read? I can follow the compliance stuff, but I'm not really a compliance expert, more of a big picture. What does the law say?
Which is what makes your perspective so tremendously valuable, Karen. I would add that Karen also is the founder and I suppose chief administrator of the fixthetextreaty.org blog, which is largely, although not exclusively, for Australian residents who are accused, whether they are or not, of being American citizens, which of course, as we know, is one of the most dangerous accusations in the world today because of citizenship-based taxation. And in the 21st century, I think, in a previous time, cocktail parties, people would talk about, well, my new house, my new swimming pool, my new car. Today, in the 21st century, the most interesting thing about a person is his country or countries of tax residency. And we'll be talking about some of those things today. For those who don't know me, my name is John Richardson. I live in Toronto, Canada. I am a lawyer who basically runs a very small boutique practice helping U.S. citizens and green card holders dig their way out of the mess that they find themselves in for having had the temerity to move from the United States. Anyway, so the title of the topic today is actually an introduction to U.S. foreign tax credits. But when Karen and I were talking about this, a better title might be non-U.S. income and taxation for Americans abroad, and how that impacts on their U.S. tax responsibilities, of which, of course, the foreign tax credit scheme is extremely important. Now, by foreign, I mean anything that takes place outside the United States. And Americans abroad, by definition, live outside the United States. So I think that probably where we ought to begin is to talk a little bit about where income is sourced. What's U.S., what's foreign, how do we determine? And would you agree with that as the appropriate starting point, Karen?
Yeah, that's really important because the source of the income, first of all, it's not always intuitive. But second of all, whatever it is, it determines who has the primary right to tax that income. So if it's U.S. source income, the U.S. has the right to tax it, and you are a country of residence, if they're taxing you on worldwide income, should give you a credit for the U.S. tax paid on U.S.
Okay,
source.
so just pause, hitting the pause button there for 1 second. So to be clear, what you're saying is that the country where the income is sourced has the primary or first right of taxation. That's
right.
what you're saying.
And then the other country should give you a credit for the tax paid by that country with the primary right of taxation, which means if you've got a mix of U.S. and foreign source income, you may be taking credits on your home income tax return for U.S. tax paid and credits on your U.S. tax return for foreign tax paid, the tax paid at home.
So would it be fair to say then that for every kind of income, the initial determination is what's the source of that income? I mean, if somebody handed you a shoebox of issues, is that how you would begin sort of sorting it out?
Well, you really can't start thinking about foreign tax credits until you know how much income is U.S. source and how much income is not U.S. source.
Okay. Yeah, I think that's exactly right. You know, one of the things that occurred to me thinking about this discussion today, do you realize, I think I'm right in saying that all of the tax problems in the world are really because of taxation of people as opposed to source? In other words, if the whole world just worked on a source-based system of taxation, everything would be easy, wouldn't it?
Well, if you were just taxing on source, you could withhold at source and it'd be done. It'd be nice and easy.
Yeah, so really the problem is, you know, in countries, of which most of them do, define tax jurisdiction in terms of people in addition to source, right?
Residents, yeah. There's a lot of countries, in fact, probably most of the countries in the world now are taxing their residents on their worldwide income. So where you live determines who has the right to tax your worldwide income, but any income you've got outside of that country is going to be taxed by the source country as well.
And the residence country is
avoid the double tax treatment.
So then the country of residence would be sort of second level down, because they would be moving, when we get to tax credits, they would be recognizing the right of the source country to have primary taxing rights, correct?
For the most part. And of course, how they do that depends on local law. So that affects everybody differently depending on where they live.
Right. Now you had also talked about residence-based taxation. And since you mentioned that, would I be correct in saying that there is no such thing as one definition of residence-based taxation, that different countries define residence in different ways?
Certainly different countries define residence in different ways, and different countries have different scope of what they want to tax.
Okay.
In terms of, what they count.
Yeah, so the definition of residency would be who is subject to taxation, and then if we move on to scope, what do they tax? That's right. Sort of a separate issue.
Yeah, okay. and that's both of those are going to be different country to country.
Okay, now if the definition of residence can be different from country to country, then I suppose it would be entirely possible for people to be tax residents of more than one country. Is that correct?
It certainly is possible. Now, most tax treaties have a tiebreaker so if you're living in a treaty country, generally there's a tiebreaker that says which of those two countries you live in, you're considered a resident of. Which can help.
For the purpose of making sure that you're not completely double taxed. That help U.S. citizens?
not U.S. citizens, because the U.S. doesn't tax based on residence. The U.S. Imposes its jurisdiction based on citizenship rather than residence. And in every single U.S. treaty, they carve out their citizens with the saving clause to say that that U.S. citizens can be taxed wherever they live.
Okay. So just
So
sort of
even if
breaking
they're a
this
tax
down.
resident of another country. So generally, U.S. citizens who live outside the U.S. are generally tax residents of two countries, the U.S.
Okay.
and
So
wherever
yeah,
they live.
pausing there. So I think that's an extremely important point, that any American citizen who's a tax resident of a country outside the United States is at least a dual tax resident, correct?
Mhm.
And because of the saving clause and the standard U.S. tax treaty, a U.S. citizen cannot use a tax treaty tiebreaker to get rid of the U.S. tax residency, correct?
Correct.
Okay. So I guess to whom much has been given, much is expected. And if U.S. citizenship is such a great citizenship, then why should they not be expected to always be a U.S. tax resident, right?
Yeah, well, it's a big problem because of the incompatibility of various countries' laws.
Right. Well, of course, as we've discussed many times, the problems are not just tax. There's a huge, it leads to huge issues of investment and financial planning and pension opportunities, et cetera. I mean, would you agree that as a general principle, the effect of U.S. citizenship-based taxation is to actually disable the vast majority of Americans living outside the United States from the kind of retirement and financial planning opportunities that are available to other people?
Yeah, well, definitely, retirement planning is difficult. But getting back to source, so there's some common misperceptions. So kind of go through different types of income and see what the rules say about how it's sourced.
Dividends and interest, should we start there?
Yeah, let's start with dividends and interest. So those are basically sourced depending on where the payer is. So if you have shares in Apple Corporation, it's a U.S. corporation, their dividends are U.S. source dividends. If you have shares in I don't know, West Farmers, which is a Australian corporation, then when they pay dividends, that's Australian source income. Similarly, interest is sourced based on where the payer is located. And that's not necessarily a trivial question if you've got corporate payers that are paying out of branches in other countries, but generally you can tell that where the payer is for dividends and interest.
Okay.
But
what about employment income? What about employment income?
Employment income is sourced where the services are performed. So if you are working in Australia, that's Australian source income. But if you're working in Australia and you go do a 1 week seminar that you give in Boston, well, that 1 week's income is U.S. source income. And unless there's a specific code section that pulls that out of being U.S. source, the U.S. has primary taxing rights on that, on that 1 week's of income.
So the area where I think there's the greatest misunderstanding is in the area of property capital gains. Would you agree?
Right. So those Apple shares, if I'm living in Australia and I own Apple shares, the dividends are U.S. source. But when I sell the Apple shares, the capital gain is Australian sourced, because the source is based on where the person who is resident, where their tax home is, where they're resident. And basically, as an Australian resident, I've provided the capital. The capital gain is Australian source income.
Now, even if you're a U.S. citizen living in Australia?
Even for a U.S. citizen living in Australia, it's still Australian source income.
And the reason for that is because that's what the Internal Revenue Code says. In other words, it
The
doesn't.
Internal Revenue Code definitely says that. Yeah.
Okay. Yeah, I mean, I think that's extremely important.
It's not in the treaties. It's in the code itself.
Yeah, and that's important, of course, because if it were in the treaty, then we might have issues with the savings clause and this sort of stuff, right?
Right.
Yeah. Okay. So step one, source. I mean, in most cases, it's fairly, but actually, just before we move on from that, so not for a non-resident alien living outside the United States with Apple shares, that would be income sourced in their country of residence. But isn't there some rule that if a non-resident alien were to spend 183 days or more in the U.S., that would shift the source of the capital gain?
So, first of all, if you've got 183 days in the U.S., you've passed the substantial presence test, and you might become a resident alien. The only time you wouldn't is if you're on a special visa, like a student visa, that says that you aren't, or that you aren't subject to the substantial presence test. But even if you're not subject to that substantial presence test, and you're there for 183 days, the source of the capital gains becomes the U.S. And then the U.S. wants to collect tax on the entire gain.
This is unbelievable. So, for example, a citizen resident of Switzerland, I believe that Switzerland does not have capital gains. Am I correct on that?
I don't know.
Well, assuming without deciding that there's no capital gains tax in a country, say Switzerland. So if a Swiss resident were to spend 183 days in the United States and sold the Apple shares, then all of a sudden that would become U.S. source income, correct?
Right. And similarly, if you've got a resident of Australia, assets purchased before 1982, there's no capital gain. So if you've got, wouldn't be Apple shares, but IBM shares or something that your grandfather gave you that were purchased before 1982, there's no capital gain on it in Australia. Mm-hmm. So if you trigger that 183-day rule, you're going to pay a lot more tax.
Yeah, I mean, this has clear implications for immigration. I appreciate we're not talking about this today, but it's clear implications for immigration and that sort of stuff. Okay.
So the other thing that we should say on capital gains is that the rules we're talking about using residence of the owner as source, that applies to personal property. So if you've got real property, like a house, an apartment building or whatever, the source is the location of the property.
Right.
And if you've got business assets, so if you're running a business through a permanent establishment in the U.S., those business assets, when sold, even though they're personal property, are U.S. source gains.
Okay. So shall we say then that it is a presumption of source to the country of where the country of residence, but there are a number of rules that would reverse that presumption, correct?
Yeah.
Okay. How can anybody do anything in relation to the United States without tax advice? It's incredible, isn't it? All right, so let's say we have an American citizen living outside the United States with various income streams. Let's start, for example, with a job, employment income.
Yeah.
Outside the United States.
Well, so the first thing everybody will tell you is, hey, you're so lucky because you get to exclude that employment income, right? That's the one thing I think most Americans know about the taxation of U.S. expats is that there's a foreign earned income exclusion. Probably more people know about that than anything else, right?
Or think they know about it, rather. Think they know
about it. Or think they know about it, right? So in 2019, you can exclude the first 105,900 of foreign earned income from your U.S. taxes.
Okay, so
it doesn't mean you're not paying tax where you live, but and so you can do that instead of taking a foreign tax credit for.
Okay, but now you use the words earned income. That sounds like not all income can be excluded.
Absolutely.
Okay, so what would earned income be?
So earned income would be basically, well, if you're drawing a salary, that's certainly earned income. If you're running a business that generates income because of your personal services, like a consulting business, that's going to be earned income. If you're there's certain pass-through income from like partnerships where you're where it's actually your personal service income. That's all going to be earned.
So would I be more or less accurate by saying that earned income is stuff that has to do with the delivery of services?
Yeah, it has to do with using your human capital to deliver services and receiving compensation for that.
Now, what if we're not looking at human capital? We're looking at income generated from other kinds of capital. Would that be excluded under the foreign earned income exclusion?
No, that's not earned income, so it's not excluded. So you'd still pay U.S. tax on that.
Yeah,
There's a couple things to think about when you're looking at this. First of all, there's a difference between an exclusion and a credit. So with the exclusion, we just pull it completely off of the U.S. tax return. It's not in your adjusted gross income, but the way the U.S. tax is computed on the rest of your income is that we kind of stack it, and you pay the higher marginal rate on any income you have that's not earned or that's not.
But an exclusion means it doesn't factor into your tax.
It doesn't factor in at all.
Okay, it's just out.
And your alternative to doing that is to do a credit. So include the income in your U.S. tax return, and then when you figure the tax at the end, subtract out the foreign tax on that.
Okay, well, we'll move to the credit in just a second. So on the here's a couple of mistakes that I see all the time. First of all, tremendous number of people, of course, include investment income under the foreign earned income exclusion. It's very common to do that. I guess don't do it. But the second thing that is interesting is that a lot of people who are running a small business, let's say their revenue is $200,000 and their profit is $100,000, would include the $100,000 figure under the foreign earned income exclusion. Is that correct?
No, you use the gross income from your services, and then you've excluded the first 100,000 or 105,000 of gross income, and you are not allowed to take any of the deductions that relate to that income because you've excluded the income.
Okay, all right. So I think key point here to remember is that it's not the net but the gross
right
that is used.
And it's only the self-employment income that's based on your human capital. So if a large portion is based on investment of other capital, then you're going to have to allocate out how much is for human capital.
Right, absolutely. So even that is not all that simple, even though people see it in a rather simple-minded way. What about the housing exclusion? That's in addition to this 100,000. I mean, I've never been completely clear on the rules, but there's something there.
On that. Yeah.
There's something there, isn't? And I think it depends on the country and all that sort of stuff.
Yeah, that's a completely different part of the rules, but it's all on that same. So the first page in the handout was the top of Form 2555, which is that's just the basic identifying information that you have to fill in to take this exclusion. And you can see that you need to talk about who your employer is. It's also, they need to know whether you've previously filed and when, because if you revoke, so it's an election to exclude the earned income. If you revoke that election, you can't make the election again for 5 years. So they collect all that information, and that's just the beginning of about a 3-page form.
So there's a lot there. But now there's two general ways to qualify to be able to take this. One is the bona fide residence test, and the other is the substantial presence, right?
Right.
Can you comment on each of those very briefly?
Yeah, so the substantial presence, or the physical presence test, is that you're physically present outside of the, or you're not physically present in the US for more than 30 days. But that's quite useful the first year that you move to a foreign country, because that 330 days that you're in the foreign country period doesn't have to be the same as your tax year. So if you move like in November, a year later, you can file a return with this exclusion. You have to get extra extensions to do it, but you can file a return when you qualify for the exclusion.
And you can base that on a number of different countries. It doesn't have to be in one country, the full.
It doesn't have to be in one country, and it doesn't, and the time of physical presence doesn't have to be all within a single tax year.
Okay. And you do not, I think, significantly, you can do this without becoming a tax resident of another country as well, right?
Yeah.
Which makes that very, sort of the official modus operandi of the digital nomad, I guess. There's an American citizen who could, travel around the world going from one to the next and take the foreign earned income exclusion, never become a tax resident of another country.
Right. Now you have to have a tax home in another country, which means you don't have a place of abode in the US. So you can't leave your house in the US and go camping around the worworld and call.
Yeah, well, you cannot have an abode in the US. I don't think that's quite linked to a tax home in another country, but yes, you have to have a tax home.
And you have to have a tax
country. Yeah, no abode in the United States. Okay, so that's one way, okay, of qualifying. The second is what's I believe called the bona fide residence test.
The bona fide residence test, which is kind of what it sounds like. Is this where you really live? Mm-hmm. This is where you've got the ties. You've got the house. You've settled there in that foreign country for.
And you're likely, which means that you're almost certainly going to be a tax resident of that other country, right?
Right. And once you meet that, you don't have to worry about the physical presence test anymore.
Right. Yes, exactly. So in other words, you could spend more than 30 days in the United States and still qualify for this thing.
Right.
Yeah. Mm-hmm. Okay. Interesting. We have a question that's come in here just before moving on. The question was, I'm not sure I know the answer to this. Can you decouple the income for Section 911, right? We have 105,000 of income. Then we have a foreign housing exclusion. Can you decouple those things? Can you just take the foreign housing exclusion and not the foreign earned income exclusion?
Yeah, I don't know.
Yeah, I don't know either.
I don't have any experience seeing that.
Yeah, I think the reason that somebody would ask the question is because they specifically want the housing exclusion, but would want to be able to take tax credits building up tax credits on a going forward basis. But I don't know the answer to that either. Before leaving, though, the foreign earned income exclusion, I think it might be worth commenting on the issue of green card holders, right, who are permanent residents in the United States. In order to keep their immigrant visa, so to speak, they have to intend to reside permanently in the United States. They lose the intention, at least in theory, they lose the immigrant visa, which we'll call the green card. The national anthem of green cardness, so to speak, is "By God, you better file a U.S. tax return." And first of all, what would be a tax return they probably should not file, period?
Well, if you say you're a bona fide resident of another country, you're kind of, admitting that you don't plan on living in the U.S., right?
I think that could be a problem. So what I'm getting at here is I think that for green card holders who want to continue filing the 1040, I would be very, very cautious with I think using the foreign earned income exclusion, but B, if you're going to use it, don't use the bona fide residence test, because you're essentially declaring, as that you're a bona fide resident of another country, which does tend to undermine, your claim of permanent residency in the United States. So I suppose if you're going to use it at all, you'd use the fiscal presence test.
Yeah. There's another question here about unemployment compensation.
Earned income or not?
Yeah. Well, if you're unemployed, how are you earning anything? No, it's not earned income.
Yeah, I think that's right.
Yeah. So that can be a problem.
Well, it's also a problem because in many countries, unemployment income is not taxed, but in the U.S. it is taxed.
Right.
Right.
Yeah.
Or to put it another way, am I right in saying that unemployment income outside the United States is always going to be taxable on a U.S. return?
I don't like using the word always, because I think there might be cases where it's considered a Social Security type benefit, where it might be excludable under a treaty as a Social Security benefit. But it would have to depend on the laws of the particular country, and I can't give you a specific example.
Yeah, and or the treaty. In any case, that's one example of, possible, incompatibility, that type of thing. Okay. Let's see.
Okay.
One last thing on the green card. Be careful to not file a 1040 NR. Even if you're temporarily living outside the United States, because that could well be construed to be an expatriating event, subjecting you to exit taxes and all that stuff. But
and potentially losing the green card.
Yeah, that too. But moving on from the foreign earned income exclusion, should we talk a bit about totalization agreements?
I think we just mention it. So if you are self-employed, the U.S. has a self-employment tax, which qualifies you for Social Security, but it's not an income tax. So you can't offset it with foreign taxes. You can't use foreign tax credit to reduce it. And you can only get out of it if the country you're living in has a totalization agreement. And there's about 14 countries that have totalization agreements, something like that.
It's more than 14. It's not a large number of countries. They are with enough countries so it covers, percentage-wise, a large part of the world, but it is a problem.
Yeah,
for example,
Canada has one. Australia has one.
Israel does not, which is a country with a lot of American citizens, which makes self-employment tremendously difficult in Israel, right? Because I think that Israel has its own separate set of, self-employment tax.
Right. So you end up paying into two Social Security systems if you don't have a totalization agreement. Anyways, so let's talk a bit about how that earned income exclusion differs from the tax credit. So that
the starting point is if we don't exclude the income appears on your tax return and it's foreign source, right?
Right.
So
that means that if your foreign tax rate is less than the U.S. tax rate, the exclusion may be good because it's going to eliminate U.S. tax that's not going to be eliminated completely by the foreign tax credit. But if you're in a country, and this would be, Australia, Canada, most of Europe, where the foreign tax rate is higher than the U.S. federal tax rate, then you're going to, by using the foreign tax credit, you're going to be generating excess credits. You're going to have paid more tax where you live than the U.S. is going to charge.
Why don't we take a very simple example? Let's say $1,000 of income earned in Canada.
Yeah.
Let's say the U.S. would tax that at 30%. That would be $300. Let's say Canada taxes that at 50%. That would be $500. So if the income is included on both returns, we have a $300 U.S. tax liability and a $500 Canadian tax liability. How do the foreign tax credit rules deal with that?
So I'm assuming we're talking about Canadian source income, in which case Canada has first right to tax. The U.S. has to allow a credit for the Canadian tax. you've paid $300 in US tax, you can offset that full $300 with 300 of that 500 you paid in Canada. And the remaining 200 that you paid in Canada is excess. And you can carry that forward to use anywhere up to 10 years in the future, or you can carry it back 1 year.
So that's really quite extraordinary. That for that type of income, by using the foreign tax credit rules, you're actually producing a possible benefit down the road. You're producing $200 of US tax paid, which could be used to offset a future US tax bill. Have I got that right?
That's right. That's right. So if you have that unemployment income that isn't taxed where you live, you might have excess tax credits from the past that you can use to offset the US tax on that income.
Okay, all right, that's quite interesting.
Yeah, so there are several situations where having a balance of excess credits is going to be really helpful. I mean, a lot of people were able to use excess credits to offset their transition tax.
Yeah, now I have
liability.
certainly seen a lot of that, where in other words, you know, as we know, I think we did one on this a year or so ago, the transition tax was where, you know, the United States, you know, made up some fake income and forced people to put it as income, as real income on their tax return and pay real tax on fake income.
Yeah.
There were a number of people who had these credits, right, that they carried forward and said, oh, really? Well, you know what? I'm going to pay that real tax generated on the fake income by past tax credits, right?
Yeah. Yeah. So that's one place it's useful. Sometimes when you get a bonus or a termination payment, that's either taxed beneficially in your where you live, like it might be taxed at some averaging rules, or it might be tax-free, but the U.S. is going to tax it. So if you've got excess foreign tax credits, I've heard of several people who were retrenched, got a huge payout, and were able to offset most of that with foreign tax credit carryovers, even though it wasn't taxable here in Australia. Another Australian example is superannuation. So if you're using what most tax preparers use as the standard treatment for superannuation, what happens is you end up paying US tax on distributions when you start withdrawing your retirement in retirement. But Australia, once you turn 60, Australia doesn't tax withdrawals from superannuation at all. So you have zero Australian tax, but the US is taxing the money that's coming out of your superannuation. So for the first 10 years of retirement, you can be using carryovers, foreign tax credit carryovers, to offset some or all of that extra tax.
Very interesting. So, I mean, just pausing for a second, as a general, you would agree that all other things being equal, use the foreign tax credit, not the foreign income.
You should be maximizing your foreign tax credit carry forwards, because you never know when you're going to end up with some income that's taxed on the US return and not taxed locally.
Yeah, or you never know when the US will make up some more fake income.
Yeah.
You know, these Americans abroad, they're not paying enough US tax. We better just give them some income, right?
The other place that you could use it is if you have enough credits in the right basket, on the sale of principal residence. The U.S. will allow you.
That is very interesting. Now let's get into that a little bit, because you know the principal residence is a consistent problem for Americans abroad in all countries that don't tax the gain on the sale of a principal residence. So there's a $250,000 exclusion. In our conversation yesterday, you said, well, you know, maybe it's good for them just to move every few years, you know, to make sure they don't have enough gain. Mm-hmm. But I mean, I think that the point is that for Americans abroad, They're either downwardly mobile people because they have to pay a capital gains tax when they sell, or they're permanently mobile people because they, have to move and move and move.
Yeah, yeah.
Sort of thing.
Yeah,
But,
so you do get to exclude for on an individual return 250,000 US of gain. So I mean that's a fair amount of gain on a principal residence, and in a lot of places that would be sufficient, but in Sydney or Vancouver or Toronto, maybe not.
well,
Especially because
definitely not if you've owned it for any length of time. That's right.
yeah, which is why moving more frequently could be a strategy to avoid the problem as well.
But
Anyways,
but what about, okay, but let's get back then to the foreign tax credit carryover, credit carryover to offset the capital gain on a principal residence. How might that work?
yeah, so I think before we can really do that in detail, we need to talk a bit about these FTC baskets, because you don't just do this all as one big lump sum. You have to allocate the tax to the type of income that generated that tax.
Okay, so on that note, if everybody could look at the handout.
Yeah.
I believe the top of the second document on the handout.
The second document shows the very top of the foreign tax credit form for 2017 and 2018. And the purpose of doing that was to highlight the differences. So if you look at 2018, there are a couple of new categories that weren't there before.
Well, let's keep it simple and start with 2017.
Yep.
So you'll see a general category. Well, what are I'm not looking at it. So taking through the categories.
So there's passive category income. So passive is interest, dividends, capital gains. And general category income is anything that's not in the other baskets, which would include employment income. You have C is section 901J income, which whenever they put an IRS code or Internal Revenue Code section on a form, you've got to be careful. That's income from countries that are subject to sanctions, like Iran.
Suspected of terrorism, isn't it? Isn't that the precise?
Well, it's sanctioned income, basically. So if
the U.S. wanted to stop Americans abroad from getting foreign tax credits, what they could do is just start sanctioning different countries, right?
Yep, that's right. They could do that, but there are other implications to sanctions that they probably wouldn't do. D is certain income resourced by treaty, which we'll talk about a bit.
Why don't we begin by just keeping it exceptionally simple?
Yep.
And let's imagine that we only have two baskets, so to speak. Okay, the general,
the passive and the general.
Now,
and before 2018, that's basically all most expats had to worry about.
So before 2018, general would include self-employment income and employment income, right? General, right. That would be both in general. Okay.
Yeah, that would be self-employment income, employment income, anything that wasn't passive.
Okay,
interest.
So we've got various categories. So that let's just keep our attention focused on the general versus the passive for the moment, and let's come back to our discussion of the sale of the principal residence.
So the principal residence is a capital gain, so it goes in the passive basket.
Okay, and the passive basket would be carryover tax credits from passive income. Is that correct?
Yep, that's right. So you would have to have enough carryover tax credits from interest and dividends and capital gains in prior years that have been taxed more heavily in your country of residence than in the U.S.
So let's say
that were not U.S. source.
Right. So let's say that you were savvy and you knew this was coming up, and you wanted to sell some of your stocks, say Canadian or other foreign stocks. Would it make sense then to sell those things to generate an excess foreign tax credit to carry forward before selling the principal residence?
Yeah, or to sell them in the same year as the principal residence, because it would all go on the same.
Right. Yeah, I think that's right. This seems to me to be a very important and relatively simple tax planning consideration for Americans abroad, right? I mean, if you're able to offset in some way a capital gains tax on a principal residence through carry forward credits, or even by selling in the same year, right?
Yeah, yeah. So if you've got a capital gain that you're going to take anyways, like maybe you need to sell the shares to, get the deposit to trade up.
Think about when you do it. Think about when you do it, and how much the tax will be, and how to use those tax credit carry forwards.
Yeah. So basically, what this points out is that everything that's in a single basket all gets lumped together. Mm-hmm. And so you basically you have the total income in that basket and the total foreign taxes paid on the income in those baskets. Mm-hmm. So that means that if you can put more into that basket in either in the year that you sell the house or in prior years, you could have carryovers that would help mitigate.
Right. Yeah, and to be clear though, you would not be able to use a tax credit carry forward from the general.
No, you wouldn't be able to use carry forward from your employment income against your house.
So really, the effect of these baskets, so to speak, is to restrict your use of foreign tax credits against U.S. tax, correct?
That's right. If you've got just one big category and not have to put them into separate baskets, that you're going to, by definition, be able to use more credits. So the more baskets we have, the more restrictive it is, and the harder it is to match up your tax basket by basket. And
that is just so totally interesting, particularly given that one of the effects of the Tax Cuts and Jobs Act was to create 2 additional baskets in the foreign tax credit thing, right?
That's right.
Unbelievable.
Yeah, so if you look at the handout, you see we've got
evil.
Yep, we've got section 951A income. Again, we're using a section number, so we know this is something.
Means big trouble.
It's trouble. And in fact, the section
guilty,
is for the guilty tax.
Yeah, section 951A is guilty. Yeah.
Yeah, 951A is guilty. And then the other new one, B, is foreign branch income.
You're kidding me. What in God's name is foreign branch income, Karen?
Well, you read all of the reports. They're talking about if you're a multinational company and instead of having a subsidiary in another country, you decide to have a branch in that other country. It's not a separate corporation, and that branch is taxed low, at a low rate. I mean, so you could use foreign tax credits from high tax countries from branches in high tax countries to offset income from branches in low tax countries, and to offset income in the U.S. from branches, etc. Well, they wanted to avoid that or get rid of that tax planning opportunity for multinationals. And so they did it by adding another basket because, like we said, more baskets, harder to use the foreign tax credits.
The United States really does hate the foreign tax credit. I mean, they regard foreign tax credits as, eroding the U.S. tax base. Remember a couple of years ago, the brouhaha over Ireland's non-taxation of Apple?
Right.
And how the powers to be pressured or essentially made a decision that, Ireland had to impose taxes on Apple. Do you remember how upset Jack Lew, U.S. Treasury Secretary, was over that?
Right. Because if Ireland imposes taxes, Apple can use that as a credit to reduce their U.S. tax.
I mean, that is just stealing money from the homeland, isn't it? Outright theft. Imagine Ireland taxing Apple on Irish profits.
Yeah. Okay. So we've got four baskets that we have to worry about, really. Now we've got the passive basket, the general basket, the guilty basket if you've got a controlled foreign corporation, and that foreign branch basket. The way defined it. It's any income from a qualified business unit in a foreign country that you keep separate books and records for.
Right. The definition, the triggering criterion is having to keep, either keeping or having to keep separate books and records.
Right.
So, practically speaking, what kinds of small businesses would be keeping separate books and records?
Well, so like if you're running a Schedule C business, a sole trader they'd call it here in Australia, and your gross revenue is more than 75,000 Australian dollars, you're subject to the goods and services tax. You have to keep separate records so that you can tell the ATO how much your GST liability is. So now you're keeping separate books and records. It's got a establishment in a foreign country. It's a foreign branch.
Oh my
So
God.
now all of a sudden your Schedule C is a foreign branch.
Or any, I think in Canada it's $30,000. So in other words, some small business,
yeah,
in Canada makes more than, is now all of a sudden a foreign branch.
Yeah, I mean, if your gross income is 75,000, you've got expenses. You're not really making an awful lot of money, really, after you pay the expenses, right? So, but what that does is it takes all of that Schedule C income and puts it in that separate basket, and now it can no longer offset anything that's in the general basket.
That's right. That's right. Very significant. So in other words, this is a very good and interesting example of how by adding, and of course we know with guilty, okay, that it cannot be carried forward anyway, okay. So the addition
guilty
of these
can't
two
be carried
baskets,
forward with that.
yeah, the addition of these two baskets has actually diminished the ability to use non-U.S. tax as a tax credit, right?
Right. And so for an Australian resident, when I was saying you would use your tax credits to offset super, but it seems to me that that your super withdrawals are going to be in the general basket. And if you generated the carry forwards in the foreign branch basket, you're going to have trouble offsetting.
I think that's exactly right. I mean, I think that this, foreign branch stuff probably affects a lot more people than guilty and transition tax. And in a lot of ways, a lot more insidious.
Oh, and I think a lot of them just don't know. They have no clue.
I haven't figured that out yet. All right. Now, you can tell from the form 1116 up there on the screen that, as usual, anything to do with the U.S. is, it's not called Form Nation for nothing. There's a lot of forms and paperwork. So certainly, I thought tax reform was supposed to make things easier. This is one more example of how, just on that level, there are more forms required. Diminish the use of the foreign tax credits, which really doesn't surprise me all that much because, the U.S. has a long history of, clearly the whole concept of the baskets is indicative of a real hostility towards the foreign tax credit, right?
Yeah, well, so Australia doesn't have any baskets.
Mm-hmm.
It's all one big one.
I think Canada has two, either business or non-business, yeah.
Yeah.
There's nothing like the complexity of the U.S. taxes.
Yeah. So the one topic we got left that we really don't want to miss here is income that's been resourced by treaty.
So if it's resourced, it means it must not be foreign to begin with.
Well, so basically what we're talking about here is we're talking about U.S. source income. Mm-hmm. So a good example, I think, is dividends on your Apple stock. Okay, that's clearly U.S. source income. But if you're an Australian resident, the Australian treaty says that for non-U.S. citizens, that the U.S. has the right to tax 15% of dividends. And then the Australian treaty in Article 27 has a provision that says that if the U.S. is taxing or any tax that the U.S. has that's in excess or that's due solely to being applied based on citizenship taxation and the saving clause, the U.S. has to allow a credit for Australian tax paid other than that 15%. So example, let's put it example. Let's say you've got $100 worth of Apple dividends, and you would pay $45 of tax in Australia on that. And if you were a U.S. tax resident, say you'd pay, or a citizen, you'd say you'd pay $30 of tax on it, right? But the treaty says that the U.S. can only take $15 of tax because there's a 15% treaty rate on dividends. So the U.S. has to rework its foreign tax credit so that it's only taking $15 of tax. And it has to allow you to use anything over the $15 that you've paid to Australia. So you paid 45 to Australia, so you paid 30. You paid the 15 that you can offset with the U.S. tax credit for the $15 that the treaty says you can pay. And then there's another 30 of Australian tax. And that becomes a credit for income resourced by treaty. And it offsets the extra $15 you paid on the U.S. return.
So it gives you a bit of an excess, I guess. Can those be carried forward?
But that's a separate basket.
It can be carried forward in the separate basket, the resource basket. Okay.
Yeah.
Yeah, the resourcing is by far the most complex area, and it depends on not only the type of income, but of course the kind of treaty that the U.S. has with the country.
Yeah, it certainly depends on the treaty. I was reading the instructions, and it's interesting. There's a little worksheet in publication, I think it's 515. Anyways, one of the publications for foreign residents. And there's a little worksheet at the end for income resourced by treaties. And the instructions say, use this one unless you're from Australia and New Zealand. And then absolutely silent on what you're supposed to do if you're from Australia and New Zealand. But Australia and New Zealand clearly have these rules that allow the resourcing. So I'm not sure what the deal is there, because I couldn't find anything that said why Australia was any different from.
Yeah, well, I think the bottom line on the resource is an extremely broad area, and the general principle is this. The general principle is to define U.S. income as foreign income for the purposes of the in a treaty, to define it, okay, as foreign income, which then generates foreign tax, and that foreign tax can then be used to offset the U.S. tax on it.
Yeah, and it has to be resourced because the U.S. rules only allow a foreign tax credit against foreign source income.
Exactly.
Your Apple dividend is certainly U.S. source income. But
exactly.
The treaty allows it to be resourced enough of it to be resourced that you're only paying $15 of tax in the U.S.
Right, right. I would point out also that this provision, although it's buttressed and given life by the tax treaties, is actually found in the Internal Revenue Code itself. So with or without a tax, I mean, okay, it's not going to have any impact without a tax treaty, but the point is the Internal Revenue Code creates and defines this resourcing thing.
Yeah.
Bottom line, it's just a way for somebody to be able to use foreign tax as a tax credit when they normally would not be able to, because it starts out as being U.S. source income. That's the general principle behind that. All right.
Yeah, and it's different depending on the different type of income. The rules are different. So there might be some employment income that, normally when you work in the U.S., it's U.S. source income, but the treaty may say that if you're working for a foreign employer for less than X number of days, the U.S. can't tax it. It's to be treated as Australian source or whatever. And that would be another example of income being resourced by the treaty, because the treaty explicitly says that it's to be treated as, or it can be taxed only by the resident country.
Right. I mean, if you want to see an example of the complexity of this, take a look at Article 24 of the U.S.-Canada Tax Treaty. It's simply unbelievable. But it's clear that, I mean, it's a good thing. I mean, the general principle is to avoid double taxation, which is always good. And also the avoidance of double taxation is a carve out from the saving clause. So U.S. citizens, of course, get the benefit of that as well. Let's see. I think that pretty much covers the topics that we wanted to. Do you have closing thoughts on this? Comments?
Yeah, basically, this is one of the more complex areas of U.S. tax, this whole foreign, well, anything foreign. You have the word foreign, and complex is there.
Penalties.
But the more I look at it, the more I see.
Penalties. Word foreign generally implies $10,000 penalty.
But also complexity. And the more I look at this, the more I see. You know, so I don't, and if somebody tells you they know it backwards and forwards and understand every little nuance, they're wrong, because I don't think it's humanly possible.
You know, a few years ago, one of the IRS compliance campaigns was on this whole foreign tax credit brouhaha. And I could see that, you know, they would recover money from audits in this area. It is not well understood. And then when you get the treaties involved in the resourcing, oh my God, I mean, it's like a carve-out specialty.
Right.
Well, so this has been a great chat. Thank you for this. And, you know, if it isn't obvious, okay, this has been, you know, how this stuff impacts individuals. Corporations pay dearly for this kind of advice. Individuals don't have enough money and will never have enough money to pay for this kind of advice.
Right. And we didn't really get into the controlled foreign corporation stuff. That whole set of rules that came out in January on previously taxed income.
Yeah, you know, on that stuff, get out of the U.S. citizenship quick time, okay? That's, I think, the moral of the story here. What do you think, Mateo?
That's the message we've been drilling for the past 6 sessions.
Must be true.
Yeah, that's our conclusion after each one of these. So
it only gets worse.
Well, thank you, Karen and John, for another insightful session. We have to start thinking about our next one. So I know we have a lot of things we can talk about.
There's no end of America's abuse of its citizens abroad. We're just scratching the surface, okay?
Yeah, so we'll take it offline and see what we can do next. Okay. I'll get some admin issues out of the way and say goodbye. If you're paying attention and you want your CPD credits, get in touch with Masha or myself, and we will make sure to send that certificate your way. Also, I forgot to plug a TaxLinks conference, which is happening in Barcelona from October 13th to the 16th. And it'll be a lot of fun, a lot of tax talk. We have a full agenda. John is going to be there covering.
You'll love it. Let me do a plug for it. I was there last year, actually, and seriously, you know, it was a great conference, great people. I mean, it's very rare in life that you can both have a great time, great discussion, and learn a lot. You know, I mean, if you want the combination of those 3 things, come on to Barcelona.
Thank you, John. We appreciate the plug. And last but not least, if you have any follow-up questions, submit them on the forum, relevant forum on foreign tax credits, and I'm sure Karen or John will be happy to reply those for you. Without further ado, all we have left is to say goodbye. Have a good weekend, and we'll see you for our next session.
Okay. Thanks for attending.
Thank you. Bye.
Bye.
Bye.